Welcome to CoreLogic's housing market update for June 2018. This month we'll be focusing on how the housing market has tracked through to the end of May, as well as looking at the factors that are placing some downwards pressure on housing market activity and dwelling values. Australian dwelling values slipped 0.1% lower in May, taking the annual change at negative 0.4% into negative territory for the first time since October 2012. In a sign that the housing market downturn is becoming more entrenched, May marked the 8th consecutive month-on-month fall since the national market peaked in September last year, taking the cumulative decline in dwelling values to 1.1% through to the end of May 2018. The negative headline result is attributable to weakening conditions across the capital cities, led by Melbourne and Sydney, where previously capital gains were nation-leading. Sydney and Melbourne comprise approximately 60% of Australia's housing market by value and about 40% by number, so the performance of these two cities has a large effect on the headline market performance. Melbourne has taken over from Sydney as the weakest housing market, recording a 0.5% fall in values over the month to be 1.2% lower over the 3 months ending May. This is the largest decline in Melbourne dwelling values over a 3-month period since February 2012. Melbourne's housing market was previously looking more resilient to value falls relative to Sydney. Recently, however, auction clearance rates have been deteriorating, inventory levels are rising, and transaction activity is tracking 12.9% lower than a year ago. Hobart's impressive run of capital gains continued and is showing little signs of slowing down, with dwelling values jumping 0.8% over the month to be 3.7% higher over the rolling quarter and 12.7% higher over the year. In Perth and Darwin, where dwelling values have been trending lower since 2014, both cities recorded a subtle fall in values over the month. However, in a sign that conditions are levelling out, dwelling values were up over the past 3 months over both cities. The annual rate of decline across Perth at 1.2% was the smallest annual fall in 2 years. The trend rate of growth has remained positive across the remaining capitals. However, conditions have lost some of their momentum in these markets too. On an annual basis, the pace of annual capital gains has slowed to 0.9% in Brisbane, to 0.6% in Adelaide, and to 2.3% in Canberra. The combined regional markets have helped to offset a broader decline, with dwelling values consistently rising outside of the capital cities, albeit at a much lower pace relative to the growth seen in Sydney and Melbourne over the previous growth phase. The combined regional markets index nudged 0.2% higher over the month to reach a new record high in May. Apart from our hedonic indices, a wide range of other measures are providing further evidence of weakening housing market conditions. Advertised stock levels have been trending higher across the capital cities, up 4.2% on a year ago, once again being driven by Sydney, where advertised listing numbers are 20.4% higher than a year ago, and in Melbourne, where stock levels are almost 8% higher. Every other capital city has seen an overall reduction in advertised listing numbers. More listings in the market mean more choice and less urgency for buyers. This lack of urgency is also evident in auction clearance rates, which have consistently trended lower since the middle of last year. Over the first week of June, Sydney's auction clearance rate dipped below 50% for the first time since 2012, and Melbourne's clearance rates have fallen below 60% for the first time since 2014 over recent weeks. Transaction volumes have continued to trend lower, with CoreLogic's estimate of settled sales tracking 7.7% lower year on year. While this figure will revise higher as off-the-plan unit sales move through to settlement, it's clear that the market activity has reduced substantially since the first round of macroprudential policies were announced back in December 2014. Previously, housing cycles have generally been influenced by changes in interest rates or in economic conditions. However, the current easing in growth conditions is very much a factor of tighter credit policies. Investors have been most heavily affected by changes in credit availability. Investment credit growth is tracking at just 2.3% per annum, compared with owner-occupier credit growth at 8% per annum. The concentration of investment activity has been heavily skewed towards Sydney and Melbourne, and it's in these cities where market demand has fallen the most. Subsequently, both cities have experienced more substantial declines in property values. With finance restrictions likely to remain tight, that's despite the 10% growth cap on investment lending being lifted next month, the chances of a rebound in the housing market over the coming months is unlikely. Investors are still facing a premium on their mortgage rates of approximately 60 basis points, more if they're not paying down their principal. Add to that the fact that lenders have intensified scrutiny around a borrower's expenses, and they're now less willing to originate loans on interest-only terms. Additionally, the Prudential Regulator, APRA, has advised banks to rein in lending on high debt-to-income ratios, which will more adversely affect the Sydney and Melbourne markets, where housing is overall much more expensive than in other parts of the country. Lenders remain focused on keeping high loan-to-valuation ratios at low proportions of total lending, with the latest data indicating only 20.8% of new loans had a deposit of less than 20%. While credit availability is arguably the major driver of the housing market's slowdown, housing affordability is another important consideration, particularly in Sydney and Melbourne, where the dwelling price to income ratio is 9.3 and 8.0 respectively, substantially higher than other capital cities. With dwelling values so high relative to household incomes and little in the way of income growth, saving for a deposit and funding high transactional costs are likely to be more challenging than servicing a mortgage for many prospective buyers. Although the exuberance has left the housing market and conditions have been dampened, it's clear that values aren't falling off a cliff. Low mortgage rates are likely to persist for some time yet, and we're seeing high migration rates supporting housing demand. Although lower dwelling values will erode household wealth to some extent, falling home values will help to ease the affordability burden that's plagued previously hot markets of Sydney and Melbourne. While housing credit growth has slowed, the trends remain positive, especially for owner-occupiers, where housing credit is up 8% over the past year. Although the outlook for housing remains one where headline trends are likely to remain negative, we certainly don't see dwelling values declining significantly. With the market changing so rapidly, it's important to keep up to date with the latest trends, facts and figures. The most up-to-date and comprehensive research can be found at the CoreLogic website at www.corelogic.com.au.